In this video, I'm going to show you how you can hedge your portfolio in a heavily volatile market that is in a downtrend or a pullback to help offset losses and make money, even though the market is going in the opposite direction. Understand that the market spends most of its time, especially over the last 200 plus years, in a bullish uptrend or consolidating. It's very unlikely that we'll spend long durations in massive pullbacks or in bearish territory. But when it does happen, it's always good to understand what we're doing, how to make money in that situation, and most importantly, hedge and mitigate risk and loss and to minimize those losses or completely eliminate them if possible. Stick around in this video because after I show you what I did on my current meta situation, I'm going to show you how you can make money in a downtrend with call credit spreads, even though we're in a bearish market. So I most recently sold a $700 put on Meta, and you probably think that put is fried and I'm in a lot of trouble. Well, I'm not, because I execute certain trades and strategies to hedge when the market goes against me like it did this past week. And I'm going to show you exactly what I did. I'm going to explain it to you. And then after I'm done showing and explaining what I did and why it works, I am going to show you how to sell call credit spreads on a smaller account to take advantage of a downtrend in a market and make money. Let me show you exactly what I did. I sold a $700 put on Meta last week. And then as the market came back during the week, it got even worse on Thursday and Friday. So what I did is I rolled out for a break even. I rolled out and down. I rolled out 3 weeks and I rolled down to 655. This was break even. So my puts are actually now down here at 655. So I'm out of the money right now. But I also did something else to hedge my risk, because as long as Meta stays above 655, and right now it's at 660, actually 661, I will be in the green. Even if Meta was to drop to say 635, 640, which is possible and somewhat likely, I would just wait another week or two and then roll out 2 more weeks and down to 630 or 640, and I'd be out of the money again, and I would be able to do that for a very small profit. It's unlikely that Meta is going to go much below that, but it could. But based off of the chart, which I'm going to show you, this is how I was able to estimate where the stock was highly likely to go. When I saw the stock dropping last Friday very aggressively, I rolled that put out, but I immediately sold a $710 call. And then after the stock continued to drop, I sold another $700 call on Meta. I collected over $1,400 premium on those 2 call options. When Monday morning opened, the stock continued to drop. And when I saw all this resistance and this big candle, I came over here and saw there's a lot of resistance and support at 670. The stock was likely to go to 670. And if it broke that, it would drop to 645 over here. And that's exactly what happened. So the stock dropped to 675, and then it broke through the support right here and fell down again. When I saw it hit this resistance at 673 and then it dropped, came back up and resisted again, I immediately sold 2 more $690 calls, putting me over $2,200 in call premium. When the stock started to drop this morning, I bought the 710 and the 7 back for like 60% gains, and the other call options are already at 50%. So by the time tomorrow comes around, I will be well over 60%, which means I made like $1,100 in change off these call options. And I'm out of the money on the put. So right now, I can actually lose $1,100 or more on this put and still profit the original $400 from the put before I rolled it out, because I collected $400 originally. And right now my 655 put is worth like $1,600 and change. So if I just bought that back and lost the $1,600, $400 plus the $1,150 means it's break even. So I can get out of this put right now for a very minimal loss, like maybe $100 to $200 or less, depending on where the price goes in the morning. This is a situation that I took that could have been bad, and I turned it to neutral. And if I decide to hold the puts then I will be up pretty close to 1,500 profit in the next 2 to 3 weeks. And this is what you do when you want to hedge. There's multiple hedging strategies. The collar strategy is another strategy that you can use to hedge your portfolio. But what I'm doing right now is taking advantage of the market being one directional. The market can't go up and be in the money on your covered calls and be in the money on your cash secured puts. Meta and every other stock in the market can't be at a high and a low simultaneously. So I'm taking advantage of that. If I notice the market is either going to continue to pull back slowly, consolidate, or maybe go up very slightly and then pull back yet again as we wait for PMI data on Monday. And we also have other data coming out this Friday. And then we have manufacturing Monday and we have services. I believe it's on Wednesday or Thursday. I have to double check. But this is something to think about. So going into Friday, so if I see the stock tomorrow morning coming up and then resists and comes down, I'm going to go up to 690, sell call options. And then Friday, if the stock has consolidated, pulled back, or even went up ever so slightly, these call options are likely to have some form of profit, and I will take profits as I see fit on those. If the stock comes up and it looks like it's really starting to come up, I'm looking for it to break the resistances here and here. So if this was to happen and the stock was to come up and I rolled this call out and up 2 weeks to say 710, 720, but then the market started tanking again after I resold this 660 put, well, then these call options that I rolled out are now going to be in the green. So I will take that profit. And as the stock drops again, I'll roll my put out and down. And as this drops, I will sell more calls. We're going back and forth. I've done this for months on end. The stock can't continuously go up 40 and down 40 and up 40 and down 40 every other day. It's just not going to happen. That's not how it works. It might happen once or twice or 3 times, and I'll just keep rolling one option out, up, sell another. It drops, I'll roll that out and down, buy that to close for a profit, and eventually it will settle down. And what we're going to see is after all of this volatility, it'll start doing something similar to this. And then when something like this starts happening, these calls and these puts are now all worthless and all the premium is mine. But you have to time it right. You have to know your resistances on the candles. You see right here, and right here, and right there. And you have to know these levels and where they're likely to go. Right now, I'm in good shape. My call options have been bought back at a 60% profit, and my put option is out of the money right now. So I am going to wait to see what happens. I'm going to see if the stock continues to drop. If it does, then I will sell more call options and let those expire next week. And then I'll roll my put out sometime next week. I'll roll out for 3 more weeks and down to 640. Once I do that, I'll wait for the stock to recover and start making its way up. And when it does, that put will start going into the green. But let's show you how you can sell call credit spreads to make money in a bearish market, because you may not have the capital to sell call options on Meta, Microsoft, Google, Apple, Amazon, Walmart, or maybe even Nike, Starbucks, or any of these stocks. So let me show you what you do on a smaller account in a bearish market to make money and to also hedge your position. Let's say if you have SoFi shares that are down, I'm going to show you how you can sell call credit spreads, whether it be a smaller stock or a bigger stock, to take advantage of the down market. Let's say on a smaller account, you wanted to take advantage of my strategy, but you didn't have enough money to sell straight calls on Meta. What you would have done is, in this situation, as I saw Meta dropping, I would have entered very similar like you would selling call options. Let's say you wanted to sell a 700 call on Meta going to next week. I think 700 is fairly safe in the market we are now, but there could be recovery. I would prefer going to this Friday, 690, because it's unlikely Meta is going to go to 690 or 700 again this week. Anything can happen. It's possible, but it's more likely Meta is going to have a lot of resistance in the 670, 680 range, that it's not going to quite make it back this quickly to 690 or 700. So let's go to this week, 3 days out. We're going to sell a 690. And you can see 690 is a 10 delta, which is very low. Let's just play it safe at 690. You click on 690, then you're going to click on buy, and you're going to buy the 680. So let's go ahead and sell the 690. They're going to click on buy, and you're going to go to 700, which is $1,000 spread. You will collect $63. Now you might be thinking, this is not a lot of money. If you're selling a naked call, which is you're leveraging margin to sell this call option as you don't own the shares. So technically when you sell calls on a leap option, a deep in the money, long dated call, when you sell covered calls against that, they're technically naked as well because you're utilizing margin as the in-between. Margin is in between your short call and your leap option long call that you have to exercise. You're leveraging margin in between that. So when I sell naked calls, they're 20%. So I need about 14,000, roughly 13,500 to sell a naked call on Meta. But if you don't have that kind of capital and that kind of margin, you're going to get half of the money that I get for way less capital. You're not going to need 69,000. You're not even going to need 14,000. You're only going to need $900. 900 bucks gets you a $63 profit, and Meta has to go up $31 in 3 days, which is possible but highly unlikely. Just remember, if you get into trouble on a call credit spread, your break even in this situation would be 690.63. If the stock closes below 690, even by 30 cents on Friday, all of the premium is yours, but I recommend buying to close maybe $5, $10 just to get rid of it and get out, because you do not want to hold these options through expiration. I don't think anybody that I've seen on YouTube or that I've spoke to, or any of my students that I've coached when they first joined, ever understood you can be assigned well after 4 p.m. Up until 5 p.m., you can be assigned on your options. If Meta was to go, or any stock was to go above your top strike, which is 700 in this situation, you don't have really anything to worry about because you're just going to be at a max $900 loss. Nothing more can happen except $900. What's going to happen is you're going to get assigned on the short call. Your brokerage is going to exercise the long call. It's all going to get done in the back end, and you're just going to be out $900. No biggie. If the stock stays below 690, you keep everything. Probably want to close it for $3, $4, $5, whatnot on Friday to make sure you're out of that position so you don't get assigned. So what could happen is you could get assigned at 690, even though the stock's at 695, and you're going to get paid $69,000. But then the following day, you're going to have to buy the stock, or that evening, whatever the price is. So you're just going to lose $500,000 on the shares, depending on where it goes. So if Meta went to 690 and you got assigned after hours, well, then you'd get paid 690 and you'd have to buy the shares at 695 or 696 and you'd lose the $600. If you want to see a dedicated video on Palantir on how to hedge losses and how to sell call options against your shares and run credit spreads and how to make money on Palantir to make back some of the losses you may have, leave a comment below and I will make a video for you. So let's take a look at Palantir. When Palantir started resisting, as you can see up here, 1, 2, 3, and then I saw this big candle and it broke below the 100-day, I would go up to a 30 delta or maybe a little bit lower, 125, and sold a call option. That's what I would have done. I would have sold a call option there. That call option would have been pretty much almost completely worthless only an hour later or the following morning. So you would have made a good decent amount of money there, maybe like $100, $120 for one call option. And what I typically would do is if you owned, let's say, 500 shares and you saw the stock dropping, I would have sold 5 call options. The stock would have came up, resisted. As this started happening on Thursday, I would have bought these back for a profit. And as the stock is dropping, this right here now becomes the new ceiling. You go above that and I would sell 113s. And then as you can see, the stock came back up. It started dropping. And by Tuesday, these would be worthless. And then as the stock's dropping here, I would go above this mark right here and I would sell $105 calls. The stock would have dropped. And today, these call options would now be worthless. So maybe like $400 here, $300 there, another $300 there. So you'd have made about $1,000 on 500 shares. So granted, this is a $34 drop, which is $3,000 for every 100 shares. And this would be about $15,000 in losses. And these covered calls would have made somewhere in the neighborhood of $1,000 to $1,500. So you're going to have to sell more covered calls, but likely you didn't buy at the top, did you? I hope you didn't. If you bought Palantir back here at 84 or even 107, we just collected $1,500. So that would pretty much put you at a lot better of a position, because even if you paid 105, you are out $1,500 for every 100 shares. You have 500 shares. You are out around 7,500. We've made back 1,500. You do this one more week and we'll get your losses down to 5,000. So this is good. And that's still considering if you bought up in here in the top. But a lot of you guys bought Palantir when I recommended it. And I think in my Discord, the average cost cost is somewhere between 40, 50, up to 80. So even right now, if you bought before this run and your price or your average price is below 84, you're still in the green and would have made all of this money. So you'd be 1,500 in the positive on 500 shares as an example. For every 100 shares, you'd be 300 in the positive and roughly, and you'd still be in the positive because you bought somewhere down here. The only people that are going to be hurting are the people that bought above 90. So if your average cost is 90 or below, you're at break even or small profit with this strategy. But if you aren't, and right now you're losing, well, right now I have a price target on Palantir of 110. So you can start selling 110 covered calls on Palantir. And if we look at Palantir, you will see that if we go out to next week, 110 call options are worth about $32. Not very much because the delta is extremely low. And it's very unlikely, but understanding the market sentiment, it's going to take a lot to break 110, and it's going to take quite a bit to break 103. So 105 or 106 is a nice fine medium for the next week. So if we go 105, it's $59. This delta is 11. It's fairly safe. I would start selling 105 calls and try to keep them around an 11 delta. If you want to do call credit spreads on Palantir, then what we could do is sell 106 or 105. And then we're going to buy 110. We'll do a 500 spread. This is $28 on 500. Doesn't sound like a lot, but it is considering the amount of capital. If we buy the 115, we do 1,000 spread, it's $42. Palantir would have to rise by a lot. $17 in a week, it would have to go back up. And you can make $42 on 958. This is a great way to make money. However, it's a little bit risky with spreads, and I like to be further out. So what I'm going to do is I'm going to buy the 120 and I'm going to sell the 110. The 110 is 6 delta. This is a 95% chance of success. It's $22 on 1,000, which may not sound like a lot, and it isn't because it's only about 3% per week, which is 12% per month. It is very safe, in my opinion, because Palantir would have to go all the way back up to here where my cursor is. Palantir would have to go up by $23 in 1 week after all of this. So you'd need to see a move that would be this big in 1 week. And it's unlikely because it has to break through all of this resistance and sell off here. In the next 2 to 3 weeks, this is likely, but in the next week, it's not. So if the stock goes up and closes out here, you can go out another week or two and go much higher, like 120. But typically, you only want to sell call credit spreads when a stock is consolidating, has a lot of resistance, or during a sell-off. So I'm not telling you to do it now. I'm telling you during all of this sell-off, when the stock would come up and have all of this resistance. Let me clean this up for you. When the stock would come up right here and it had all of this resistance and started dropping, you would have went up above that right around here at the top of this candle and sold a 120 call credit spread, which would have made you like $40 on 1,000. And the stock dropped and it would have been worthless. So this isn't a trade alert or telling you to do it now. It's telling you how to do this while stocks are dropping. The same thing can be said for a firm. You see how the stock's dropping? It comes back up here and starts to sell off, comes back up. And when it starts to sell off here, go above the previous resistance, which would be about 77, and sell a call credit spread. If we had done that, look what happened to the stock. Completely worthless. It's like a downward staircase or a staircase going down. Every time it comes down and goes up, right at this peak, it starts to drop, go above the previous and above the 100-day average and sell a call credit spread. This is how you can make money during a downtrend. It's the same way we do this on an uptrend. We see the stock go down, and as it starts to go up, we're at a support, we sell a put. Same thing with a call option. The stock drops, it resists, it starts to come back up, but as soon as it resists again and starts dropping, we go above the previous resistance and sell a covered call or a call option or a call credit spread. I teach this to my students in the Discord, how we can make money every single time the market's going down or every time the market's going up. It doesn't matter. You can see by the profits on the screen that my students are making consistent income. Whether the stocks are going up or down, there is a strategy to hedge, to play it safe, and to make money consistently. Safely, slowly, consistently. If you guys are interested in joining my Discord, my training course, and my one-on-one coaching, I would love to help you. At any time, you can sign up at investwithcorey.com. The link's in the information box below. Just go to the website, click on training, and you'll be able to watch a video to book a call with my team and I so that I can help you achieve your financial freedoms. Maybe you want to retire, maybe you're just starting out, or you don't know where to begin, or you're losing money. I would love to help you, and I look forward to seeing you very soon. If you guys want to see a call credit spread video on Palantir and a detailed one specifically for Palantir and SoFi, let me hear your comments below. Take care of yourselves. I'll see you on the next video.